Welcome to the Page One Podcast, a podcast featuring a variety of guests and thought leaders on topics ranging from digital marketing, sales channel strategies, influencer marketing, best-in-class product launches, and all the details about how to accelerate sales. Now, here's your host, Luke Peters.
Thanks for joining us on the Page One Podcast. I'm your host, Luke Peters, CEO of New Era Appliances. And in this episode, you're going to hear from Neal Asbury on how he built his massively successful global business, the legacy companies, what others can learn from his success. Also, we're going to touch on the U.S. economy, U.S. world competitiveness, the trade deficit, and other ideas around solving these problems. And so let me just tell you a little bit about Neal. When it comes to advocating on behalf of entrepreneurship and free enterprise, there's no one more passionate about these subjects than Neal. Neal is the chief executive officer of the legacy companies. In 2008, he was a recipient of the coveted United States National Champion Exporter of the Year Award. The legacy companies is a diversified group of businesses engaged in manufacturing and distribution, doing business in over 130 countries. So he's built a really, really significant business. We're going to dive into that. And additionally, Neal, each week he hosts a nationally syndicated talk radio show called Neal Asbury's Made in America. Made in America features leading political and industry experts and is carried by more than 100 affiliates coast to coast. He also wrote a book called Conscientious Equity, an American entrepreneur's solution to the world's greatest problems. And this has become a respected guidebook to help American manufacturers engage with the world of trade, fighting corruption, environmental issues, and preserving human dignity. His advocacy has taken him to address the UN Commission of Trade and Development, as well as frequent speaking engagements at universities, government events, and trade associations. So that's quite the intro. Hopefully I didn't miss anything there, Neal, and just wanted to thank you for joining us on the Page One Podcast today.
Hey, Luke, thanks a lot. I mean, that was a very, very kind introduction. I really, really appreciate it. And I've been very much looking forward to being on your show. I've heard so much about it.
Okay, cool. So why don't we start just so the listener gets a better idea of more about your business, the legacy company. So you've built this massive worldwide company, 17 brands, at least that's what I counted this morning. Just tell us a little bit more about what types of products you sell and maybe who your customers are.
Yeah, we're a manufacturer. I mean, I'm very proud of my manufacturing roots. My manufacturing roots actually started in Southeast Asia. And maybe we can talk a little bit about that later. But I've been in manufacture since early on in my career, creating my first manufacturing company in Southeast Asia and the Philippines in 1988. And as a sidebar, I got the contract to build all the McDonald's restaurants, the kitchens of the McDonald's restaurants, and to install them throughout Asia and the Middle East. In fact, we built the first 1,000 McDonald's restaurants in China, which gave me a very good understanding of that country, from its very, very beginning of opening up in the early to the mid 80s. But anyway, the legacy companies has grown and evolved to become a manufacturer and exporter of kitchen appliances sold to the consumer market and to the commercial market. And these 17 brands represent some, a very big cross section of products that you would see in homes, in your home kitchen, on your counter or built into your counters, as well as if you went to a restaurant, whether a fast food restaurant, a hotel, or any sort of food service or catering operation, you see all those big, beautiful stainless steel pieces of equipment, refrigeration, cooking equipments, warewashing equipments, storage equipments, all of that sort of stuff, steam cooking equipments, very important in our portfolio. And so we got a very, very strong presence in the commercial food service market, as well as in the home consumer retail markets for kitchen appliances and gadgets.
Great. And then, jumping in, and I know a lot of the audience is business owners, and we're all dealing with COVID and some of the changes we've had to make internally in our companies. How's that looked for you at the legacy companies? Have you guys had to go to remote? And just beyond the obvious, what type of changes have you had to make?
Yeah. Fortunately for us, we have been deemed to be an essential business because a lot of the products that we manufacture and sell and service are sold into hospitals and institutions and so forth, medical facilities. And so we were able to stay open throughout COVID. We have a manufacturing operation, distribution operation in Sacramento and California. We have 2 different manufacturing operations in Pennsylvania. We have manufacturing operation in Georgia. We have another manufacturing operation in Florida. And we were able to comply with these states and keeping our business open, which I think was very, very important. Now, having said that, obviously we, went to much more of a remote work environment. And, in our distribution facilities, our main distribution facility is in Paris, Kentucky, just near Lexington. Obviously, if you're distributing products, you need to have people on site and, doing that work. We were able to keep our manufacturing operations as well as our distribution operations and limited office operations open. And a lot of our employees went to remote. And until today, we still have about half our workforce still working remote, those that can. And it's been a very interesting experience, to kind of go through this and to go through it as quickly as we have gone through it. We have several hundred employees, so it wasn't like a small feat. Having the technology and the capability for people to work remote, the security of your network. We had that was, as you can see in the paper, you hear every day of another very large company being hit with ransomware, right? Because there's so many people working remote. So there's a tremendous amount of challenges to get from, say, the middle of March until today. But fortunately, we seem to have come out the other side a better company than we were when we went into it.
Well, that's amazing. And so I counted 6 manufacturing facilities in the U.S., at least 1 distribution center, a couple hundred employees. And I guess before we leave, the question of COVID, we've had to do the same thing. So smaller company at New Air, but we are remote and we've stayed remote, except for our warehouse, and that was deemed essential as well. But, there's now kind of a debate amongst different business owners on, some of them really like remote and they're just going to continue. And then others can't wait to get back to the in-person collaboration. And I can see both ends of it, but I think especially for, sales meetings, it's doing a meeting on Teams just isn't the same as having everybody there in person presenting. Where do you fall on that side of the spectrum?
I'm an old-fashioned guy. I believe that, people sitting in a room together and being spontaneous, just very quickly saying, hey, let's go grab lunch. I got an idea I want to share with you. I mean, that the benefit of that is immeasurable in running a business. At the same time, we're not going to go back to the way we were. We're just not. And I think that a lot of us has learned to do certain things with technology that takes real costs out of our business. And as such as, having, people travel everywhere every day of the week and, doing presentations and so forth. Can you cut your T&E back by 50% because of the sort of new way of doing things and this technology being tested? How much office space do you need? Do you have to have these big, fancy offices, lots of square feet, costing a lot of money for people to come to work, when half of those people can work from home and be just as efficient and better in some regards? Now, I think that it's going to really depend on the type of work, right? For us, our sales team, and we have about 16 people that are actually in the traveling sales side of our business, have historically worked from home, right? Most of our salespeople work from home. So that has always been kind of like the way we've done that. E-commerce, our e-commerce team, is working from home. And, they're working all these odd hours and, they're not really 9 to 5 people Monday to Friday anyway. I can kind of see them, working remote and more of the e-commerce team being remote and maybe not even being in the same town. To recruit talent right now, Luke, as you know, is very, very hard. And one of the benefits we're going to find in certain key categories of talent, like e-commerce, is going to be they want to work from home. People want to work from home. I mean, that's a big part. Hey, why not? You don't have to drive. You get another hour and a half, 2 hours of your life every day. You don't have the wear and tear on your car. There's a lot of benefits, right? So I could see why, people will look at remote as a way of retention and attraction of talent. So I think we're going to have a hybrid of what it used to be to what the new economy post-COVID is going to look like. And as a company, I could see 20%, 25% of our workforce continuing to work remote. Whereas if you asked that to me before COVID, I would say, less than 10%. And maybe even 25% would be understated. Maybe it's going to be more than that. And, it's kind of, let's wait and see. It's going to be fascinating to see how this whole thing shakes out. And what does our customers, like your customers too, how much do they want to receive people into their facilities? Will their people be working remote? Will there be customers that you can actually go and visit? Or will they say, hey, you don't need to come. Why don't you just have a Zoom meeting? And we'll meet once a year instead of 4 times a year, and 3 times a year we'll do it by Zoom. So our customers are going to make a big decision for us about how we conduct our business in the future. And so this is going to, cut across all parts of our business and everything that we do.
Yeah, those are all great comments. And just a few thoughts on my part as you're kind of going through those is, like, on the recruiting side, look, we have 9 or 10% unemployment in the US, but for a lot of these key positions, it is extremely hard to recruit, and the talent is limited.
You're right. It's right. It's counterintuitive that we got this unemployment, but you can't hire people.
Yeah.
And by the way, Luke, let me tell you, it goes right throughout the economy. I mean, I have all these manufacturing facilities. I can't find people to work in factories. You got 8, 9, 10% unemployment. You would think that people would want, these manufacturing jobs, which, by the way, pay very well, but we can't find people to work.
Yeah.
We can't find people who want to work, but yet there's this unemployment thing, but you can't find people to work. It's completely upside down. It's completely upside down.
I don't have an easy answer for that one, but it's a phenomenon, right? And especially at the higher level technical positions, these folks, they want to be their own entrepreneur. They're working for you, but they want to call their hours and they want to hit their goals, and they don't always want to be told how to hit the goal. They just want to hit the goal that's agreed upon. And so it's a mindset.
But part of it, Luke, and I've talked about this on my radio show a lot, is that, and it's not now, but I think that the residual effect is still there, is, when COVID hit, they had the $600 a week bonus for unemployment for people to stay at home, right? So if you took that plus the regular unemployment payments, people were being paid by the government to stay at home.
Yeah.
Right. It wasn't worthwhile to go to work. And if you had access to unemployment, why would you go to work? Right. So, we're competing with the government, paying people to stay at home, incentivizing people to stay at home with all this government money and subsidies. And here there's real jobs in manufacturing, and we always talk about bringing our manufacturing jobs home. Well, here we're bringing our manufacturing jobs home, but the government is paying people to stay at home, so we can't fulfill those positions. I mean, that's a tough circle to square. Explain that one. But now, obviously, we're past that now, and they're still talking about this next stimulus, and what's going to happen, and what the incentives going to be, and so on and so forth. So we're finding people, coming back to work, but not nearly to the level that we need them to.
And it's been a big problem, for folks like in the smaller businesses where, maybe their wage is just a little bit above, some of the entry level wages. And so with that $600, it was, crushing salons and other companies like that. But, we'll have to see how that plays out. And
well, what does that equal? That $600, that equates to $15 an hour, right?
Yeah.
And then on top of the other unemployment benefits, people would be paid, $18, $20 an hour or more to stay at home. In a lot of the country and regions of the country, that's a very, very big wage. And the entrepreneurs, the manufacturing entrepreneurs, the risk takers, our inventors, our small business owners can't compete with people staying at home being paid $20 an hour, right?
Yep. And
that's why, by the way, Luke, again, counterintuitive, that's precisely why our manufacturing jobs are relocated overseas. The U.S. government is making it impossible for us to compete.
Yeah, and we're going to get into that, and more than that, we'll get into it. Let's put it that way. But some of these, the rules other countries play by are also different. And it's like a quasi capitalism that some of these, that some of the other powers are using, where the government supported entities and having to compete against ours, and even ours are somewhat government supported at the top. But we'll dive into that a little bit later. And before we do, and before we leave this topic, though, I was just going to comment that on the work at home, I don't know what we're going to do either, but I do miss the in-person for the culture part. I miss it for the idea generation. And maybe it'll go to something where, it's a couple of days a week, everybody's in, and then most of the days everybody's out, depending on what their, what job what their function is. But there's something to it, to get the team together once a week, depending on job function. But that's what I'm leaning towards now. And I haven't really made any big decisions here at New Era. So I'm just kind of wanted to use a wait and see, because it works so well to go remote. And I think that's kind of what you're saying too. Remote has worked so well, and we're going to have to all feel these things out as business owners. Why don't we move on to, talk about, so you have all these brands, and maybe from like an operations perspective, Neal, and we'll get into this, how you did this, how you kind of acquired or brought together all these brands, but how do you keep everything connected? Whether you look at an org chart and it's one person overseeing all of them, or multiple people overseeing all of them, or whether it's a software that keeps everybody connected, or do they all run separately and then just, the P&Ls all roll up to the one legacy P&L? How does that work for you?
Well, it's a good question, and it's an evolving situation. And the way that I've built legacy is, for the most part, 70% of the business volume and our net revenue is about $250 million. So about 70% of that has come from acquisitions, from M&A activity, and not buying big companies, because in the beginning I couldn't afford big companies, and but I kind of grew, and I kind of went up the food chain, and there was other companies I could buy and another company I could buy, and they progressively got bigger. About 30% of our business is brands and products that I created on my own. So now, if you take a look at our company, we essentially consider ourselves as three different platforms, or kind of maybe even better to look at it as three concentric circles. And these circles are kind of overlapping each other. And, that's something that I've always, kind of imagined would be a very interesting business model. So you could operate in different industries with a lot of the same back of the house functions: engineering, manufacturing, product development, accounting, legal, human resources. A lot of these, even though you're in different industries and have, somewhat different customers, but a lot of the company can function, and you can leverage from that because you have so many synergies happening within these industries. Let me explain. Like, one of those circles would represent the commercial food service industry. Another one of those concentric circles that are overlapping would be the consumer small appliance business. And then the third concentric circle overlapping would be our compact appliance division, Avanti, a company that you know very well. So You have these three circles, and they're kind of overlapping. And what I was always inspired from, when I was living in Asia, I lived in Asia for 20 plus years, and that's kind of where my career started. And looking, at America from afar, is brands like Hamilton Beach and brands like KitchenAid, brands like Rubbermaid, and there's a lot of them, Waring, Vitamix, Blendtec. I mean, I'm sure these are a lot of brands that many of these brands started in the commercial food service industry as commercial products, and then they morphed into both commercial and consumer products. And then the consumer business became much bigger than the commercial business, although they started their life as a commercial business. And I really admired these companies because they were able to live in two worlds or three worlds at the same time, but they were able to use that brand and everything that created that brand to sell to this very diverse customer base. And if you look in the investment community, The investment community, loves diversity, and that not one thing has built the business. Because if one thing's built the business, if something were to go wrong with that one thing, then the house falls, right? Or something bad happens. But if you can spread your risk across various industries, you're going to potentially weather the storm much better than, say, a company that's wholly dependent on one market segment. So when I designed Legacy, I wanted to have that same concept that these really iconic brands utilized, that they could operate and perform well in multiple industries, but yet leverage from the same core technology and the same core talent pool in the real estate and the engineering and the production and everything could support not just one industry, but two industries or three industries with the same branding and everything else. So how do we manage that? So since we have these three concentric circles of these three different platforms, but all overlapping and having customers overlap and many different things overlap, we have management teams who are responsible for each of those three: our consumer division, our commercial division, and our compact appliance division. And my job, is to get the best talent I possibly can, and then get out of their way and let them do what they do. And we have great people. We have talented people running those divisions. And my other job is to get them to cooperate and work together so we leverage all these relationships that we have. And that's essentially, what is Legacy? That's who we are. We are Legacy. We're a combination of these three concentric circles working together with great management teams, working together to leverage our customer base and our supply base.
Yeah, that makes a lot of sense. And thanks for kind of spelling that out, because you do have all these different brands, but I can and I was taking notes here, but I can visualize in my head, putting those three circles together, and I understand the market, so I can understand those, three categories, and then you having to just build teams in three categories instead of 17 different categories, right? That would be, a bit of a challenge. And you kind of explained it, that you have, built about 30% or so are the brands you built, and 70% was M&A. And I had a thought or a question on this about, okay, you've, acquired these brands along the way. How do you maybe, if you're talking to other entrepreneurs, do you think they should be doing more of that? Because I got to tell you, listen, me and a bunch of my other business owner friends, we always say we want to do these acquisitions, but when you haven't done them, it's a lot easier to just grow your own business. But you now have experience doing it. So do you think it's kind of the route that folks should take, but maybe are not?
I think that everybody's got to find their own balance, right? I don't think 100% M&A is very good or sustainable. You have to ultimately know, once you buy a company, how to grow the company, right? So if you just buy companies and you don't do anything with it, or you're not focused on that organic growth, then why buy the company? And if you just buy a company that doesn't have any synergies or value drivers or anything that you can, 1 and 1 equals 3, because, you have a company, you buy a company and you put them together, and the sum total is much greater than the two parts, then you've done something really good. You've created shareholder value if you've been able to do that. But ultimately, you must grow the companies organically. And so if you have a way of growing your business without doing M&A, then that's great. Then that's something to pursue. But if you want to accelerate that, a couple of strategic acquisitions could set you on a whole new course. And that is also very good. So I think you should really consider both. And, it shouldn't be one and not the other. But obviously, just like you have to grow your business organically, and that's something that you have done incredibly well, and by growing your business organically and not having to go out and raise capital and go into the financial markets to do M&A work, because that takes a lot of time, and it's something that you got to learn. And you've done very successful doing that. But I wouldn't turn my back on saying, hey, I want to try to figure out the M&A world too. And M&A doesn't have to be like you're out there spending huge money. I mean, there's a lot of really great entrepreneurs out there that for whatever reason, wherever they are in life or whatever, they're at, or maybe they want to go try something else. But there's a lot of great ideas that you can attach to your platform and then again get the benefit of that 1 and 1 equals 3, or maybe 1 and 1 equals 4. And, that could give you a product line or a category, or can bring you customers. It can bring you part of a supply chain that you don't have. It can bring you expertise in e-commerce or through, traditional sort of retail and customer, whatever it can bring you. But if you had access to that, you could run everything through what you're currently doing through this new sort of platform, this new channel that you might be able to acquire, and really fast forward what the result would be. Because, if you do this all through a homegrown basis, it can take a while, right? As you know, it takes a while, and it goes at its own pace. But if you do a great acquisition, what would take you 10 years, you can accomplish in 6 months. And that would mean you are really creating shareholder value. And ultimately, I think as an entrepreneur, what are we trying to do? We're trying to create shareholder value. Ultimately, that's, one of our, I can't say it's our only goal, but it's certainly one of our most important goals, is to create value.
Yeah, well said. I think that's the main, obvious point, but the key point is that with M&A, you can speed it up, but it does take, it takes a unique skill set. And, folks, people like you have done it a lot. You know where the pitfalls are. And so you've learned from those, so you have a better chance at success, and then kind of around that, you talked about, previous to that, you're talking about, connecting all these companies together. And how do you do it? You hire the best people, you get out of the way because you want them to run those teams, but you still have to drive the business. What are the KPIs that are, top of mind to you? It's easy, that, hey, we're going to look at P&Ls and maybe strategic plans and investments and balance sheets. But is there something, different or unique or interesting maybe that you follow, on a weekly or monthly basis?
Well, just to keep it simple, and, this is, I think, for any entrepreneur and any business owner, you're essentially looking at two things. It can really be boiled down to two things: cash flow and asset management. And, when you do buy and you're out in the financial markets, borrowing money, it's all about cash flow, right? And it's about leverage ratios. It's about fixed charge coverages. And, these are formulas that are, very much, are tied to, the money that you're creating, the dollars that you're creating in the business, and what can that support? So very, very important, especially if you're going to try to access the financial markets. And the other is really good asset management. And what's asset management really? Mostly for most entrepreneurs, that means their inventory and their receivables, and making sure that, you have good inventory and the stuff is moving and you're not sitting on a bunch of dead inventory or obsolete inventory, and that your receivables are coming in, and, you're not, getting receivables out there in that 150, 180 and beyond, because banks look at that and, you can't borrow against it. So you want to make sure everything that you have, all your assets, can provide you liquidity. And very important, as an entrepreneur, even as an entrepreneur who's not doing M&A, as you know, is making sure that you have good, strong liquidity. And as we went through COVID, what was the big deal? Nobody really cared at that point about how much money you were making. People were worried about running out of dollars, right? They were worried about running out of liquidity, because it would not be fun going back to the banks, in the last 4 or 5 months and saying, I ran out of money. I need more money. So liquidity, especially in the world of COVID, became the most important thing. But cash flow and liquidity, two very important things. And that's what, I spend a lot of my time thinking about.
Yeah, you're spot on there. As the first call we got from our banker was liquidity, the very first thing. And because nobody knew it was going to happen at that time, right? And they just wanted to make sure that we knew that's what they were thinking. And then that basically them telling us that's what we should be thinking. And fortunately for us, we've been positioned really well because we're strong digitally. But yeah, you are 100% correct. And I guess, every business owner has a different bank relationship, right? Some are on a cash flow loan, some don't have any line of credit. Some do have a line of credit, and some have maybe an asset-based line of credit. And so each one of those is going to require different ratios that are required or looked at by the banks, and kind of like a different level of financial strength on their end to kind of be able to share that type of reporting, whatever it's required. But yeah, that's an interesting view, and it's like a very financial view, which I guess is, like you said, you want to, one of the main goals is create shareholder value, and that's kind of where your mind is on, making sure that these important financial metrics are being covered. So kind of on the same line, you're building shareholder value, and that can be measured a number of ways. You could be looking at, things that are increasing the valuation of your company, things that are literally giving you immediate profit right now. What's kind of been had the biggest impact, or how do you look at, growing wealth? Okay. Inside the business, has it been, obviously buying and building has been a part of it. Some companies, just focus on profits. Some focus more on other metrics that they know are going to be valuable to maybe an eventual investor or even to their own business. I don't know. Do you have any thoughts or an answer on this? And the reason I'm asking is because, the audience here are business owners. Obviously a lot of them love running their business, but personally they also want to build wealth. And some of them do it outside of their business, with real estate or whatever other investments, but the majority is in the business. So curious your suggestions on thinking about that.
Yeah, very good. I mean, very good. And, creating value. I mean, that's, first of all, whenever you're building a business, you should be thinking about who would be the buyer of this business, right? Because we're not going to live forever. We're not immortal. We're going to, something's, in life, we're going to go through, a transition in our lives. I mean, from our working professional lives. And that doesn't mean that there's a time that we all do that. I mean, I know people well in their 80s and, they're still loving it and enjoying it and doing it, beautifully. And then I know people, who kind of set a time frame that, they want to be out earlier than that, much earlier than that, because they have other things that they want to pursue. So always understand when you're making decisions, who would buy this company, right? Who would be interested in this? Who's my target audience when it's time to sell? Okay, so I think that's very important, because I think, and I fall in that trap too, is that I just say, oh, wow, that's like a shiny, beautiful object, and I want to have that shiny, beautiful object. But then, once I get the shiny, beautiful object, did it really fit into my strategy? And is it part of the strategy for the exit? And if it's not, that's not necessarily a good thing. And if it is, that could be a very good thing. And you just got to be disciplined. You got to be very, very disciplined, so when you're making those decisions, that it fits very nicely in with your exit plan. And you got to have an exit plan. So then, when you're building your business, how are the valuations done? Well, just everybody agrees upon, or that it's a multiple of cash flow. And, all of the investment community, investment bankers, all these people that you're going to meet, they're going to look at your business. They're going to look at the cash flow. They're going to look at it over the last 36 months, 24 months. They're going to see how you're doing, and they're going to see what sort of growth you have, what kind of programs you have, and different things that you got going on in the company. And they're going to try to sell the sizzle that, if you buy this company at this level of cash flow, it's got so many things going on. It's in a great industry and it's going to grow. And so therefore, by investing in this, because of all the momentum that it's got going on, this company over the next 24, 36 months is just going to be doing incredibly well. And therefore, your investment is going to do very well. And that valuation almost always is tied to your earnings, a multiple of earnings. And typically in our industry, it's somewhere in the 7 to 10, right? So depending on where you are, and if you're a growing company and your brands and maybe your product development that you have, or have you transitioned to the new economy, and are you really figuring out e-commerce, and are you on the cutting edge of e-commerce? There's different things that, put you in the higher range, and there's, a more tired, staid, stoic business that's not doing anything, and it's just kind of like sitting there and kind of stuck at some place, is going to be on the lower end of that range. So, that's the best way for an entrepreneur to cash out, is because they've created real cash flow that people are willing to pay a top multiple on. And, that's where people have gotten phenomenally wealthy by, creating those kind of businesses. And, so that's another thing that, as you're making your investment decisions, how will this impact your earnings? How will this impact your cash flow? How will this impact your growth trajectory? So you're getting on the higher end of that multiple, and you're not going to be stuck on the lower end of that multiple. Now, the problem is that a lot of entrepreneurs, they're lifestyle companies. So they're really not making money, right? Because they're taking out a nice living, but they're not really making profit. And those companies, a lot of them are sold and a lot of them are successfully sold, but they're not going to bring in the really big money because, they're not making money. And, they're going to, maybe not get, what they had imagined, and because they're not really creating cash. And if they're not creating cash, the investment community that's really paying big dollars is going to move on and look at something else.
Yeah, it's a great answer. I remember talking to a banker and a couple years ago, and he put it in a very, obviously along the lines of what you're saying, but also in a really interesting way. He's like, look, companies need to get to this EBITDA percentage, and that it was a different way of looking at it. But he said, because when you're at that percentage, of course, there's other factors, the size of the business, the growth rate and all that. But that, when they get to this percentage, which is, higher percentage, it's going to vary on everybody's industry. But, it means, hey, they're doing something special. They can demand, this percentage of profits on their products because they're doing something special. And those are going to be, brands that are really interested out in the marketplace.
Well, yeah, what you should do along those lines is to understand where you fit, is look at some of the public companies that's in your space and take a look at where they are with their gross margins, take a look at where they are with their overhead, take a look at where they are with their EBITDA margins, and then you could see the multiples that they're getting, right? Because the public market, you could see what the multiples that they're getting. And that's something good to benchmark against. And that's kind of what we benchmark against. And if you look at a lot of the appliance companies, you're going to find that their gross margins are somewhere in the 33 to 38%, maybe 40%. You're going to find that EBITDA margins are somewhere between the 12 and 15%. Take a look at days inventory outstanding, your DIO. Take a look at your days sales outstanding. You're going to see, some really good information there. And if you see, a DSO or a DIO, you look at your EBITDA margins, you look at the gross margins, you look at the sales growth over the last 3 to 4 years, and you see who's really getting, a premium for their stock, that would be a good target for you to shoot for. Because if they're getting a premium, it means you're getting a premium. If you're underperforming against, the medium of that group, and you're not benchmarking well, then it shows you the work you need to do in order to get you into that club. And if you're there, then you have a really great story to tell, a really great pitch to tell to the investment community of why investing in your company that's performing at a Class A pace, and why you deserve the upper end of the multiple.
It's great advice. And it's honestly not that hard to do. I mean, all this is publicly reported, like you said, and it's going to and those are exactly, especially the first two, you got the gross margin and the EBITDA. These are all things that we can compare against these publicly traded, especially if, your company is reporting in GAAP format. It makes it a lot easier.
Yeah, you got to do GAAP, because anybody, worth their salt is going to come in and do due diligence and hire a quality of earnings. And, someone, Alvarez Marsal or FTI or, one of these big consulting firms will come in, and they're going to be looking and making sure that, when you're recording your income, that, you're doing it correctly, and it's normalized according to GAAP, as you said. So, don't cheat yourself, and make sure that you understand the way that a potential investor would look at you. And that's a great exercise, by the way. It's a great exercise to do and to know, how you're benchmarking against the industry and if you're going in the right direction.
Yeah. Well, thanks for sharing that. And I was going to share like just a funny story. I got to keep my friend's name hidden here, but I got a buddy call me up for some advice, and his company is, it's under $5 million, but he just needed some advice on some accounting things and some suggestions because he's not as sophisticated internally because he doesn't have as big a team, right? He's only got about 5 employees or so, but he's doing 50% net profit margins. Okay. And after he shared that, I go, the funny thing is you're probably making more money at the end than 95% of the people you're talking to, even though their business is maybe 2, 3, 4 times bigger, whatever the case is, like in his, in his different business groups that he's in. So it's funny. We're all growing businesses, but at the end of the day, I was just so impressed by what he had done with this company and how lean they were and how, during COVID, when growth had happened, they were able to basically, pump out more widgets with the same team size. And he's not, he loves his business. He's not looking to sell it or anything, but it kind of fits into, really tracking these things that are really, really important instead of just the top line and, numbers that at the end of the day aren't paying the bills. Yeah.
Yeah. It's interesting. I mean, like I said, there's all kinds of companies out there that's got all these very interesting metrics, so, as an M&A guy, as an entrepreneur, it's fun to kind of go and pick through that and, see where the gems are.
Yeah. And Neal, kind of back on, so we've talked about this a couple of ways. I'm going to ask us this one. This is a little different question, but just because I really understand, what makes you tick and what you're spending your time on. So in a weekly, I'd say even a daily or a weekly basis, however you want to answer, your time's limited. You're growing a diverse organization, hundreds of people, multiple physical locations around the country. Like, where's your time going, basically? And also, is there a specific strategic planning process that you like to follow? Like, where's your time and how do you know what to do every day? Do you have something that, that drives you on that side?
Well, when you have a company, as diverse as we are and just, with all the M&A and, lender relationships and vendor relationships, customer relationships, employee relationships, regulation, government regulation, just what's happening, obviously, with the financial markets and COVID and, how to just keep our doors open. It's, just like every entrepreneur, you wake up every morning and you're unemployed and you have to go out there and make things happen to get a paycheck. And every day those things can be very different, so I can't say that there's just kind of like a normal day. And especially in these abnormal times, it's very hard to predict, from one day to another, where I can make the greatest impact. It's exciting, but it's also daunting too, right? Because, you never know what's going to come at you. And, but that's what makes you get up in the morning. That's what gives you your drive. So it's hard to say, Luke, that, here's typically what I would be doing. It's just like any other entrepreneur with a smaller business like the one that you just described with the 5 employees and the 50% EBITDA margins. They got to wake up and handle many, many different things in the course of one day to be successful. And I think, that's what entrepreneurs are by definition, is that they're very flexible people that has to go and move and groove with whatever is thrown at them. And as I gotten bigger and I got more employees and just a lot more real estate and a lot more things, that really has not changed. So from day to day, just never can tell what's going to come at you.
Yeah, I can relate to that. Listen, I do want to have time to kind of jump into what you talk about in your book. So why don't we transition from business and I think, we talked about a lot of great subjects there. So appreciate all the openness and your answers on that end. And you wrote a book called Conscious Equity, an American Entrepreneur's Solution to the World's Greatest Problems. What are the main problems that you identified in the book? What really stood, as huge problems that entrepreneurs can be a solution to?
Well, Luke, my career, I graduated university in the U.S. and I spent a year in Manhattan working at a trading company on Lower Fifth Avenue. And then from there, I was on the way to my dream job in Singapore in Southeast Asia. So I was in my early 20s and here I am in Southeast Asia. And I was working for a large British trading firm and I was the sales manager of one of their divisions that sold commercial kitchens, commercial food service equipment throughout Southeast Asia, East Asia, Australasia, South Asia, and the Middle East. So my job, young guy, just traveled all the time. For 7 years, I never really had an apartment. I just lived in hotels everywhere that I went. Even when I was home in Singapore, I stayed in an apartment hotel that, once I stayed there for a few weeks and worked out of the head office, I was on my way, for another 3-month trip. And, I just did that for a long time. And I was selling American food service equipment, and I was traveling throughout this very, very fascinating, diverse part of our world. And I was competing against, very large European companies, Korean companies, Taiwanese companies, Japanese companies. This was before China had opened up. And so the Chinese weren't part of this yet. But we were competing against all of these different countries and, competing for, $3, $4, $5 million projects, the catering operations of an airport, that's big. Catering operations of a large university. I mean, these contracts are big. The food service operations of a Hilton hotel, the Shangri-La hotels, you name it. And we were out there bidding and competing for that business. And we won a lot of it, but we lost a lot of it too. And what I came to see is that American businesses were being openly discriminated against with impunity from our trading partners. And these trading partners were supposed to be our allies. And, they were putting up tariffs and other non-tariff restrictions to us selling our products. We couldn't get our products, into these countries at a fair and reasonable price. There was regulations, all sorts of things. And then on top of that, there were government subsidies being given to their contractors and exporters, the corruption and all of this. And in my country, we didn't have the government behind us. I was an entrepreneur against the world, and I didn't have my government supporting me. In fact, I'm not advocating for corruption, but whereas, these people were out there openly bribing different officials in order to get jobs in the United States, that's a felony. And, there's a lot of people that's gone to jail because of the Foreign Corrupt Practices Act that was enacted by the U.S. Congress. So I was being blocked from selling because of tariffs and non-tariff restrictions. I was competing against people that was getting heavily subsidized, that were not playing by the same rules, and American products were not flowing into the market in a way that they should have been. Yet, foreign manufacturers had complete access to my country. I just did not have access to their countries. And coming back to America and meeting, the various factories that I represented throughout Southeast Asia and these various areas that I was doing business in, I was meeting with people working in these factories that I was selling their products. And everybody was nervous and scared because, they see the foreign competition and that their jobs are being taken away. And it was so sad to see these people at home so fearful of their jobs because of foreign competition. And I knew if they would unshackle me, if they would take off the handcuffs, and if I can compete in the same way that they were allowed to compete, we would win, and we'd win a lot more. So conscientious equity is my story of what it was like being an American, selling American products throughout Asia and Middle East, and competing against all these other subsidized countries, and the jobs that we were losing because we could not compete. And then these same foreign manufacturers using all the money that they're making because of the unfair trade practices, and then investing it to sell their products back to the United States at lower costs to drive American manufacturers out of business. And some of these regimes were the most corrupt, despotic governments of the world that abused their people. And made them live in poverty and squalor and have no access to clean water and health care and so on. And I thought that, boy, this world is very, very screwed up. So conscientious equity, conscientious because it's the right thing to do, and equity because we all have ownership in doing the right thing. So I imagined in conscientious equity a world where America competed freely and fairly. And I described what that world would look like. And I described the policies that we enacted that were hurting us and policies from overseas allies of ours that were hurting us, and giving solutions on what we needed to do to clean this thing up. And if we would, all good people of the world would benefit, not just us. Conscientious equity is not just for America, it's for the world. And if we all competed in this sort of way, the world would be a much, much better place. And so that's my first book, Conscientious Equity. And lo and behold, what is happening in America today, in the debates that we're having, in the solutions that we're discussing, have all been written about before in Conscientious Equity. I told the story of what is happening today 10 years ago. And it's kind of fascinating to me that exactly the sorts of things that I talk about in Conscientious Equity is unfolding today pretty much as I predicted.
Well, let's dive into that, because it's like, I'm a, lifelong free market guy, but then when you get into it, you realize, obviously we have the China tariffs, so I can ask you your opinion on those. But, the interesting thing is, I think, and you know a lot more of this than I do, but like, our products are tariffed everywhere, right? And for the longest time, economists or leaders would say, well, it is better that, we're not charging tariffs for X, Y, and Z reasons, which everybody can make an argument makes sense. But it does seem like one big result that no one ever wanted to talk about was that, okay, if our stuff's tariffed going out, but nothing's tariffed coming in, it really does put our companies, or USA-based companies, at a big disadvantage. I guess nobody was looking out for them along the way, but now, tariffs are on China, and it was funny. I had a friend, really, really smart friend, by the way, brilliant guy, and he said, his thought was, look, I actually agree with the tariffs. And he was being negatively impacted by these. He goes, I agree with them. The only thing I want to know is, will they be there for 20 years? Because then I can plan. But if, things go up and they change next year and then they go down, then it becomes a huge problem. But, why don't we get your opinion on that, since you have, I'm sure you have a strong opinion. What are your thoughts on kind of the current situation there?
Well, the tariffs, in my opinion, are misplaced. And I'll give you one example. Is that 50% of what we import from China are components and materials that goes into U.S. manufactured products. The steel and the aluminum prices in America are the highest in the world. So how can we be competitive internationally when the most basic manufacturing materials are the highest price in the world, right? So by having these artificially high prices on commodities and products and materials and components and so forth, that the American manufacturer needs in order to build really great products and to be able to export them and sell them around the world, we're shooting ourselves in the foot. We're not helping the American manufacturer. We're making their products more expensive. We're making it more difficult. And to say that, that we put these tariffs on China, no, we haven't put these tariffs on China. We put the tariffs on the importers of the products coming from China, which by and large are all American entrepreneurs and companies.
Yep.
And ultimately those tariffs are being, pushed on to our customers, because many of the products that they're tariffing have no other source to buy from, right? So it's not like, oh, we're going to put a tariff on this product so it's made now in the United States. Those products are never going to be made in the United States again. It doesn't make sense for them to be made in the United States again. So ultimately, it's the American importer who is, got a lot of people on their payroll. And then at the same time, the American consumer who's getting hammered because of these tariffs, and the price is just being tacked on. I mean, President Trump is wrong. I mean, he's saying, well, China's paying the tariffs. They're not paying the tariffs. They're not paying the tariffs. Americans are paying the tariffs, and American manufacturers are paying the tariffs. And we are now less a competitive global source of many, many, many products because we have higher manufacturing costs of our materials. So this is only accelerating products to be shipped offshore. And it's even worse than that. Look, steel and aluminum are tariff very high as a raw material. If you import a range, a commercial range, a fryer, many of these products that are made from steel and aluminum, if you import it as a finished good, there are no tariffs.
Yeah, exactly.
So you're tariffing the things that the American factories need, and you're allowing the products that are coming in using those same materials coming in duty free. It's the most insane thing in the world. The implementation and the execution of this, they just don't know what they're doing. They don't know what they're doing.
Well, I think it's botched there's probably a lot of lobbyists. There's a lot of lobbying going on for individual categories. And like you gave a good example, some categories are they don't get tariffed. Other categories do get tariffed. And it's honestly kind of hard to understand one from the next. But yeah, you bring up a great example.
So that's a problem. The other, and if we're going to have access to foreign markets, and we say we need to have access to foreign markets, which, by the way, I'm at the forefront of that whole thing. We got to have access to foreign markets. I fervently believe in that. But if we don't make competitive products because the tariffs are driving up the cost of our manufacturing, then how are we going to sell these products? And once we have access to foreign markets, if we're not competitive. So yes, let's open up the markets and let's have these markets, opened up to us in the same way that their products are being sold to us. And what many of our competitors have done, Luke, is that they have said, okay, we're going to lower our tariffs. And if you look at the official tariff rate on a lot of these countries that we do business with, they have come down remarkably. And they're much, much less than they were when, I first started my career in Southeast Asia in the late 70s, early 80s. The business is very different, and the access to these markets have increased because the duties and the tariffs have come down across the board in many of these countries. But what have they done instead? Because tariffs became very political. So, we're going to have very low tariffs. They created regulation and approvals and all these different things that restrict the product, not because of paying a tariff, but because of having a certification that you need on that product to be able to import it into the country. And then they charge you very high fees and excessive fees to get the certifications. And if you're an entrepreneur and you're looking at that and you're saying, wait, it's going to take me 3 or 4 years to be able to sell enough product to be able to pay for these certification costs that this country is imposing upon me, even though that the tariff rate is very, very acceptable, but it doesn't justify me spending that $15,000 or $20,000 to get that certification. I'm going to take that money and spend it elsewhere. So they have accomplished the same thing through their certification protocols. So, unfortunately, our trade infrastructure, and I talk about this in conscientious equity, is a short stopover. These senior positions are a short stopover on the way to another career. And it's like, you're punching your ticket here that, I was in the administration, I held a very important position in trade, and now I did that for a year and a half, and now I'm moving on to some big fancy schmancy lobbying position in Washington or some other job because you had that administrative sort of role. And unfortunately, many people running our global trade infrastructure are that mindset. And we're competing against career trade negotiators that are trained at an early age, and they stay in these positions for decades, and they're running circles around our neophytes. And we keep giving them more and more neophytes, and they keep training their people to wait us out, and then don't worry, someone else will be in that position, and it's going to take them a year to understand, where the restrooms are, and then after that, they're gone, and then, whatever they say, we'll just wait them out. They're making a mockery of us. And, I discussed that also in conscientious equity with real live examples of it.
Wow. That's a great insight, Neal. And I mean, you've been on the front line, so you know exactly how it's done in those countries. It seems like the problem, why don't we end with, I'll give you another question here. We'll end on this one because it is a complicated one, but it will be interesting to get your thoughts, and I'm sure the listeners will enjoy it. And that's kind of around it's related because it's around the change in, it seems like there's an ever flowing consolidation. I don't want to go too far on a tangent, but in science, there's something called entropy, and that's there's a law around it, by the way. And it's that, everything goes from, say, a state of order to disorder. And it's like we went through that stage, like when say in the digital side, when it first opened up, everything was new for the pickings. But now there's these, economic forces that have come together, and you have huge consolidation. Google, Amazon, Facebook, so on and so forth. Along with this consolidation, these become global companies, and they often get, our support. They have huge lobbying groups. And then the companies they're competing against, say from China or other countries, are going to have their government support. And then you got to do it on your own. I got to do it on my own. So it kind of, you have this bifurcation basically. And if you're one of these huge companies, you have these huge, you have advantage and benefits. And for everybody else, you got to figure it out, from bootstrapping it. Do you see it a different way, or, do you see this as a big problem, or is it kind of just always been there?
It's always been there.
Yeah.
The entrepreneur is not asking for anything for free. We're willing to fight the good fight, but at least make it fair, right? Make it fair. We all believe in economic freedom. We're not asking for handouts. We just want to have a fair shot at things. And, that's it. And if our government isn't, that we pay taxes to, and if our government is, taking our money, and their job is to protect us and to make sure that we have access to markets in the same way that they have access to ours, that if there's all these other games being played around the world, that America, the strongest country in the world, 5% of the population of the world, 25% of the world's wealth, and if we're relying on this government and they're not showing up for us, that's a big problem. And then when they show up, they're doing it with people who really, haven't thought this thing out. And then you look at the administration, and I'm not beating up on Republicans or Democrats, because this has been going on forever. I mean, Democrat as well as Republican administrations have been equally guilty, to just being there, for their period of time and not really fixing problems, having a vision, having a strategy in order to defend the American entrepreneurial community. And despite that, look at all the things that we've been able to accomplish. But I'm not looking at what we have accomplished. I'm looking at what we could have accomplished and what more we could have done. And at the same time, I'm looking at the risk that we have if we don't get this right. Let me tell you, China is coming at us, very hard. They're coming at us very, very hard. They're in this to win it. They're in to win. They're in to win. And I'm not criticizing them for being in it to win. We should be in it to win. And if you're working from a position of strength, you'll be able to accomplish great things. But, in conscious equity, I talk a lot about these structural issues and what's happening in foreign countries and what's happening in our country and the type of policies that would really, really, really help our American entrepreneurial and exporting community. And if we were to do these things, the jobs we would create, the prosperity that we would usher in, it would be like nothing we've seen in our history. It would be so, so beautiful and so big. But, it's going to take some real skill to pull this off. And up until this point, I haven't seen, that sort of visionary come into power to where they know, what buttons to push. And, we got to figure this out. We got to figure out quick. What I believe, and I'll end with this, that I believe that the vast majority of the world's wealth has still not yet been created. It's a very important statement, that the vast majority of the world's wealth, no matter what we've done from the history of the world until today, pales in comparison to the wealth that will be created from this generation onwards. So the question is not if this wealth will be created, because this wealth will be created, and it'll be so much greater than what we've experienced up until now. But the question is not if, it's where. Where will this wealth be created? Will it be created in our country, or will it be created somewhere else? And if it's not created in our country, what is that risk that imposes on us? And who are these people that's going to have that power? And will they have our interests at heart? And I suggest they absolutely will not. Will that wealth be created in our country and invested in our schools, in our roads, in our hospitals, in our universities, in our social programs? And if it is, think of this country like, my goodness, it is going to be so incredible. But if we lose this and we miss this, the risk for our children, our grandchildren, and their children is unimaginable if we don't get this right.
Well said. And we have to play the long game for that reason. So we'll leave it at that because I think you said it beautifully. And Neal, again, I just want to thank you for joining me today on the Page One podcast. I think our longest episode yet, but I loved all the topics that we got into, and I know the listeners are gonna get a lot of value out of this. Before I let you go, how can listeners find you? Connect with you maybe on LinkedIn, and I know your book is Conscious Equity. It's on Amazon, so they can find that book there.
Yeah, I have the my second book is being published in March. I'm very proud of it. It's with National Geographic. The best-selling National Geographic author of all time. He and I have partnered to write a book. It's called The Birth of America. That's another thing that I'm very passionate about. I have one of the largest collections of antiquarian maps and engravings in the country. I have. And so all that knowledge and everything I learned from that, together with Jean-Pierre Isbout's, we put together this beautiful book. It's being published in March. It's going to be available everywhere. It's going to be a great book. Conscious Equity, as you say, available on Amazon. And Neal Asbury's Made in America is produced by Radio America in Washington, D.C. We're on 100 plus terrestrial stations. You can see on, where you are, and if a station is nearby you, we're in many, many places. We're also heard, and I'm very proud of this, and broadcast every week by the AFN, the Armed Force Network. So all of our military bases, embassies, all of our ships, wherever there's an American government outpost anywhere in the world, is broadcasting Neal Asbury's Made in America every week. So if you went to either Neal Asbury's Made in America.com or you went to RadioAmerica.com and just look for Neal Asbury, you'll see all of my shows that I've ever done have been archived there. And so we talk to a lot of fascinating people like you do, Luke. It's very, very interesting topics, kind of going from one to another in a very short period of time. But we cover a lot of different things. And remember, it's all about policy. It's not about personalities. What do we got to do to promote economic freedom? Because that is the only way to the American dream and American prosperity.
Well, listen, we're going to have all of that in the show notes, and thanks again for being a guest. And I couldn't agree with you more on the last point. Look, I got kids, right? And I've been fortunate enough to have a successful business, but then, you have the next generation, and that becomes more and more important. And we got to make sure that there is and are those same opportunities for them. So we'll leave it at that. Thanks again, Neal. We'll have all this in the show notes and links to the various ways that people can find you and to your books, and wish you a lot of success on the release of your upcoming book next March. Definitely will check that out. And for the audience, hope you enjoyed the interview today. I really appreciate your reviews on iTunes and hope you join us for the next interview.
Thanks for listening to the Page One podcast with Luke Peters. If you enjoyed this episode, please help us out by leaving us a rating on iTunes. Want to double your online sales? Check out www.retailband.com. And don't forget to join us next week with our next amazing guest.